Hello, everybody, and thank you for joining us today for this month's webcast. My name is Carl Newhouse, and I head up the engineering team here at MSI, and we're going to be talking about current market trends that shape the oil and gas industry. So we're going to start with a little overview of the economics that we have today in the 2017 E&P business. We're going to talk a little bit about the driving factors that we've seen the last 2 years. Capital expenditures, briefly glance over the M&A market, what bankruptcies meant for the industry. We're going to talk about refracturing, as this was something that was brought up to us by our clients. We're going to take a brief look at international shale and particularly at Argentina. We're going to look at the long-term U.S. energy forecast that the EIA released at the end of January, and then we're going to talk about how MSI has reacted to all of this. And I think everybody's listened to or has read and seen a lot of forecasts from prices and inventories and supply and demand. There's a lot of very intelligent research out there. We're trying to provide a concise overview of some of the highlights, and we're going to go into some detail, but not to the extent we're going to make a sophisticated financial model or anything. So looking at the economics at the bottom here, you can see the wellhead break-even prices for various unconventional plays, and you can see how they were all pretty high at in 2013, and they've come down substantially. And the U.S. shale industry has certainly become a lot more competitive throughout the past few years, and those capital efficiencies were driven by a number of things. There were drilling efficiency gains, service costs that had been substantially reduced throughout the downturn, but also enhanced completion technology and treatment designs. And those cost efficiencies have actually lowered break-even prices to the point where a lot of operators can make very good returns at very low oil prices. So Continental, for example, reports a 100% rate of return for their Bakken wells at just a $50 oil price. So the shale industry has definitely become more competitive. However, as prices stabilize and then pick up throughout the year as expected, some of that service cost decrease will reverse. So we're going to see a service cost reinflation probably in Q2 if you listen to some of the CEOs of the larger service companies, and that will continue as prices rise. So with that, we're going to see break-even prices increase slowly. Some of the analysts estimate by up to $10 by the end of the year. So the break-even prices that we see currently, or that you see on that chart here, are probably at a historic low. The big difference here, comparing the U.S. shale industry to some of the international players, and especially the OPEC and the Gulf countries, they are really dependent on the oil price for their national budget. So almost all the OPEC countries and the Gulf Coast countries need a $50 or more break-even price, oil price for their fiscal break-even. So there's definitely a large contingent of oil producers that are very interested and almost need an oil price to not just stabilize, but increase to the $60 or $70 region. So looking at some of the driving factors, some of the highlights that have happened throughout the past couple of years, the initial gap between supply and demand has decreased due to the continued depressed prices. So we're at a point now where with the OPEC cuts, if they're successfully enforced, that supply and demand imbalance will flip to where we have just a little bit of an undersupply. However, as prices recover, it's a sensitive balance to where price recovery leads to additional production, which leads to increased supply and increased inventories, as we've seen in some of the numbers that were published in recent weeks. With a steady demand or slowly growing demand, we're going to have some excess capacity as well. So it's a sensitive balance. We'll see how it plays out. However, like I said before, with the break-even prices, U.S. shale producers don't necessarily have to wait around for the price of oil to rebound. There's a lot of operators that generate very attractive returns at $50 oil and still pretty decent returns at $45 oil, at least the ones that have acreage in the core of some of these unconventional plays. So the market as a whole is certainly constrained by the demand side and by the pace of the demand growth, and obviously there are some geopolitical factors that impact supply. Now, the world has watched OPEC for a while, and as they were discussing cuts, there was a lot of uncertainty if they, first of all, would agree to anything, and then if those cuts are being enforced. I think now we're seeing that the cuts that they had agreed to are actually being enforced, so that's a very positive sign. With some non-OPEC members, such as Russia, they agreed to about 1.8 million barrels per day in reduction in production, in global production, and just the 5 countries, which are Saudi, Kuwait, Qatar, the United Arab Emirates, and Russia, represent a very large portion of that total cut. So if those countries adhere, we're going to see a situation where our oversupply turns into a deficit almost immediately. We have a little bit of an oversupply, the last numbers that are being reported. However, even as we've heard news that OPEC countries adhere to these cuts and that you have 80 or 90% compliance, inventories are still increasing. So there's still a little bit of uncertainty in the market, and I think that's certainly reflected in futures contracts throughout the rest of this year. As prices improve and as global supply decreases, U.S. production can certainly fill that gap. So we're going to see again what that does to a very sensitive balance. And like I said, there's some uncertainty based on recent reports when it comes to inventories. The IEA predicts a very slow demand growth of only 1.2% in 2017, so that's below recent levels, and that may point to an underlying weakness in the global economies or just an increase in efficiencies. So we're going to see very, very slow growth of production in the U.S., very slow oil and gas production growth. And as far as natural gas prices are concerned, they're expected to increase to meet demand if the oil price remains low around the current level, and natural gas prices are expected to be flat or even slightly decrease with higher oil price due to the associated gas production as new oil wells are being brought online. So translating those highlights and some of those driving factors into capital budgets, if you look at the plot on the upper right-hand part of the chart, you can see total capital spending for 2 groups of companies. We have the major oil companies and we have the smaller companies. And obviously, as prices crashed in 2014, everybody's capital budgets and capital spending was substantially reduced. And in the U.S., something that we've seen is especially that reserve-based loans have been reduced substantially, and available credit throughout the downturn was actually cut by about 40%. There was a very high reluctance to new loan originations that's pushed a lot of people into very dangerous territory, which we'll cover in just a little bit. The high-yield debt market was effectively closed, not surprisingly. However, at the end of last year, at the end of 2016, banks extended their credit lines for the first time in 2 years. And there are some companies that track this and track companies' credit lines. And at that end of year round, 34 mid-size independents had their available credit lines increase substantially. Overall, analysts expect E&P spending to increase by about 20% year over year in the U.S. However, even major companies will shift their capital spending from long-term conventional exploration to unconventional development that generates cash flow or free cash flow and break even in a much shorter period of time. So they're targeting break even in about 2 years, 2.5 years. I think Chevron just recently announced that they're going to spend 70% of their budget on projects that break even and pay out within 2 to 2.5 years. So the lack of investment in large and capital-intensive projects is something that we're going to see on the supply side in a few years from now and in the decade following this downturn. So what is the industry going to do with the available capital? They're going to use it to fund acquisitions, of which we've seen a substantial amount in the second half of 2016 and beginning of 2017 already. And they're going to accelerate development in their core positions, delineate their acreage. And as service costs inflate or re-inflate, the service costs rise, those higher budgets may not necessarily translate into too much higher production. Something else that we've seen, access to capital. Obviously, the public equity market was very, very limited to only the highest quality secondary issuers. We've seen talk of a few IPOs. One of the companies that filed for an IPO just got recently bought. However, the private equity market, on the other hand, has a substantial amount of what they call dry powder. So there is a significant amount of capital waiting on the sidelines that was raised during previous fund rounds that they weren't able to deploy in the last couple of years. So there's a lot of capital that will fund the industry and fund acquisitions in even some of the fringe areas of the plate. Some additional considerations here are just a brief synopsis of the M&A market. For the majority of the downturn, the bid-ask spread and the price uncertainty was really prohibitive for any type of investment. The acquisition divestiture market was pretty much closed and non-existent for 2015, opened up a little bit and picked up some momentum in 2016. In the second half of 2016, we've certainly seen a remarkable number of asset transactions going into 2017. That's going to continue. We've already seen some billion-dollar transactions in the first couple months of the year, and for the most part, there's two types of transactions here. There are either high-quality properties that are offered by non-distressed sellers. So, for example, a private equity company that exits to a publicly traded E&P company, or what's referred to as high grading, which is companies divesting of assets that are not aligned with their core position, but are still really good and highly desirable assets. Something else that the recent pickup in transactions has brought about is just an increased competition for core assets. So we've seen some tremendous prices and acreage multiples in the Permian Basin, for example, that were basically unheard of 6 months ago. As far as bankruptcies are concerned, Haynes and Boone, they track bankruptcies, and they put out their end-of-year report, or their report in January of this year, that 114 North American oil and gas producers have filed for bankruptcy since the beginning of 2015, and those 114 companies represent a total amount of almost $75 billion in cumulative secured and unsecured debt. So that's that had a substantial impact on the industry. A lot of companies went through bankruptcy proceedings, and obviously I think everybody was impacted by that to some extent, even just individual investors that had some common stock that got wiped out, for example. As far as refractoring is concerned, we've been approached by our clients in the beginning of the downturn about experience related to refracking. Obviously, refractoring presents very attractive economics, so we have operators that want to improve their wells in good acreage that they completed a few years ago with what's considered now a subpar treatment design. However, there's a lot of variability in the success of these refractoring treatments. There's a lack of experience, so they asked us if we had any experience, if we had monitored any refracts, and we've developed a workflow and found some interesting things which we'll talk about at the end of the presentation, how we've reacted to some of these driving factors. As far as the international shale development is concerned, on the right-hand side here you can see in the table that there are a number of countries that have substantial shale gas and shale oil reserves. However, commercial production as we see it today is only really available in 4 countries, which are the United States, Canada, China, and Argentina. We have a few countries that have intensive shale exploration efforts underway, such as Australia, that's been going on for a while. The UK, Mexico is looking into it, especially as the Eagle Ford, for example, just extends across the border. Russia is looking into it. We've done some projects in Russia. And then Algeria and Colombia are also trying to understand the extent and feasibility of their shale resources. However, the type of shale development that we've seen in the U.S. in the past years, probably starting in 2008, 2009, requires the drilling of a large number of wells in a very short amount of time. So the logistics and the infrastructure to support that type of development are not really in place anywhere outside, well, even North America, really. The U.S. and Canada probably have most of that infrastructure. There's some in China, there's some in Argentina, certainly ramping up, but outside of those four countries, there's really no infrastructure available to start development on a U.S. type scale, if you will. Something else that plays a role here is the ownership of mineral rights, which in most countries, except for the U.S., are usually government-owned. There's different taxation regimes, which is a problem in Argentina, which we'll get to in a second, and social acceptance of fracking and the oil and gas industry as a whole definitely plays a role, which is something that we've seen in Europe, in the UK. So looking at Argentina specifically, the president there announced in January that Argentina will support the cost of new drilling by ensuring returns for the companies that are willing to invest in Argentina. They are setting or continue to set the natural gas price in the country at $7.50 per million BTU. That was extended through 2020 and is then gradually phased out, so it approaches the international price for natural gas. That's obviously supposed to attract outside investment. They're also going to decrease a higher oil price over time and make that more similar to the international spot price. But overall, they're really trying to attract outside investment. However, we haven't really seen a huge production increase. We've seen a little bit of a production increase. Problem here are high production costs, and then there's not a lot of flexibility in the availability of labor. So that's something that they will need to work out and have started to work out. So as a result, only 2 of the 19 concessions that were awarded in the Vaca Muerta have actually begun producing. And if we look at 2017, there are a lot of companies that want to invest in Argentina. The biggest ones here are probably YPF, Chevron, Total, Shell, and Pan American. Together, they have pledged to invest $5 billion in 2017 and then double that investment in coming years. And YPF, as the national oil company, obviously has the largest share here. The problem here is that Argentina suffers from a substantial energy shortage, which obviously has an impact on their fiscal budget. And analysts estimate that the Vaca Muerta shale would need a total long-term investment of somewhere around $200 billion to reverse that energy shortage. And on a federal level, like I said, the president there made some announcements recently. The province where most of the Vaca Muerta shale is located, which is the Neuquén province, they are also trying to incentivize investment. They're going to stabilize taxes, and they're working with labor unions so they can offer more flexible contract terms and a more flexible workforce, which is really necessary to attract investment and make production cost competitive. So after looking at the U.S. and some of the international shale, come back to the U.S. but look at the long-term U.S. energy outlook. If we look at the chart at the bottom here, that's something that was published by the EIA at the end of January, and we're going to see a continuation of the increase in dry natural gas production. We're going to see crude oil coming back to the level of 2014, rising gradually throughout 2025, where it begins to level off, and then everything else is basically decreasing or remaining stable except for renewable energy. On the consumption side, in the US, the EIA estimates that consumption will remain relatively flat. So we're only going to see about a 5% increase from the 2016 level by 2040. Obviously, that is highly impacted by economic growth. Some other things here that have an impact are the technology that we use to consume the energy. So there has been tremendous efficiency gains recently in various industry sectors, and then there's a low and a high oil price scenario. So there's different scenarios. What I'm showing here in this slide and referring to in this slide and in the next one is kind of their base case scenario, and you can go in. It's a pretty extensive report. Has some very interesting scenarios, so definitely worth a read if you're interested in more details. The natural gas use here and the production that supports that increases more than than consumption from other fuel sources, and that's really led by the industry and electric power generation. Petroleum consumption, and the reason why we see kind of a leveling off of crude oil production, remains relatively flat. We're going to see even more energy efficiency gains moving forward in the transportation sector, and as far as the industrial activity is concerned, some of that will be taken over by natural gas. And total energy production, looking at the chart with the substantial increase in dry natural gas production, will actually increase by more than 20%. So that's a bit of a contrast to a rise in energy consumption by only 5%. And obviously, like I said, that's dependent on different scenarios, different factors such as technology, resources, and market conditions, and to some extent international geopolitical considerations and international economic drivers. Now, looking at the map down here, we can see where some of that production, or most of that production, is coming from. If we're looking at the oil production on the left-hand side, you can see that the blue curve here shows the Southwest. If we look at the map, that's mostly the Permian Basin, and they're definitely expecting most of the oil production to come from that Southwest Permian Basin region, followed by the Dakotas and the Rocky Mountains. So that's the Bakken, that's Niobrara. The Gulf Coast does provide a major part of that production growth as well, and then the rest, the Mid-Con, the West Coast, and the eastern United States, in terms of oil production, are definitely substantially smaller than the portion of the three other regions. If we look at shale gas production, most of it will come from the northeast. So we have the Marcellus, we have the Utica Play. Some of it will come from the Gulf Coast, such as Haynesville, for example. And the rest of the U.S. will contribute a little bit, but obviously not as much as the other areas. So in general, the shale oil and shale gas production will account for about 2/3 of total energy production in the U.S., and some of this may actually change over time as we continue to improve the technology with which we recover the oil and gas from shale reservoirs. And obviously international demand, international supply, things like that will have an impact on how the U.S. responds to that as well. So after looking at highlights and driving factors that we've seen throughout the downturn, some of the considerations that we've talked about, I want to talk about how MSI as a company has reacted to that. So as prices have decreased, as capital budgets were reduced, and as service costs were reduced, obviously we reduced our costs substantially as well. And the important parts here are that any personnel and workflow efficiency gains we've directly passed on to our customers to offer a more competitive and, in the environment at the time, obviously a more sustainable price. We've given substantial discounts, so some of you who've received proposals, you've seen discounts that you haven't seen, I think, ever in the history of MSI. We've offered some flexible payment terms, so we've definitely worked with our customers to continue to provide services that provide value to their operations at a cost that is palatable in the current environment. The other thing that we've really focused on was the return on investment. So we've kind of shifted our focus from the geophysical and science niche to more actionable results in the engineering and completions optimization space. We've closely collaborated with asset teams to really understand what they need and how they use our results and how they would like to use our results, and come up with actionable results as deliverables in every project. Something else that we really focus on is the follow-up and the project aftercare, if you will, to make sure that our results are actually being implemented to help spread the value throughout other teams in our client organizations. So we're definitely a resource even after the project is completed, to make sure that our clients get the most value out of the projects that they've done with us. On the A&D side, we've supported a number of customers in achieving the highest possible returns and a higher asset valuation with just a limited number of wells through the microseismic. So we've used microseismic data in data rooms, and we've positioned the analysis that we provided to reduce the risk for a potential buyer. It's really the only image that you get of how the reservoir responds to your treatment, and our customers that have divested of assets have seen tremendous value in that transaction process, because they had microseismic. They could really show how the reservoir responded to the treatment. As far as refracs are concerned, I mentioned that we were approached by a few customers that wanted to learn about our experience with refracs and if we'd ever monitored some. We've monitored a few. We were lucky enough to have a few cases where we also monitored the initial completion, so we'd directly compare the initial microseismic results to the microseismic results of the refrac. So that has helped us greatly to understand the viability and the success of a refrac. So we've certainly seen a lot of variability as far as success is concerned, and actually developed a methodology around that to ensure the stimulation of the entire wellbore in real time, and we'll get to that in a couple slides. As far as development is concerned, we've really proactively invested in our technology development to facilitate efficiency gains, to validate our results, and to provide more actionable results to our clients. We focused on the integration with reservoir modeling and geomechanics, which I'll talk about in a little bit, and we've really partnered, and we're lucky enough to partner with our clients to calibrate some of our workflows and validate the results, and like I said, produce results that lead to actionable recommendations. So as far as the technology development is concerned, we've asked our clients what their project goals were as far as microseismic projects are concerned in general. 45% of our customers said that their main objective is really to get an understanding of the frac geometry, length and height of your fracture network. And then 30% of our customers their main objective was to get the discrete fracture network, understand the size of the stimulated reservoir volume, and understand where the proppant is placed inside of that stimulated reservoir volume and discrete fracture network. And then 25% were really interested in more of an advanced product where we determined the permeability enhancement from the microseismic and used that in reservoir simulation to forecast production. So our technology development in the past couple of years was really focused on three areas based on those responses and based on some other feedback that we've gotten. Obviously, we have our user group meeting every year, which is a great source of feedback for us. And every project provides an opportunity to get feedback if what we're doing is actually valuable and we're providing the right things to our customers. So on the reservoir engineering side, we focused on quantifying the permeability enhancement that you see in the reservoir from your hydraulic simulation. We then take that permeability enhancement, put it into a reservoir simulator, and forecast production and long-term depletion, which obviously then has an impact on your wellbore spacing as you understand the long-term depletion pattern. On the completions engineering side, we focused on resimulation. Like I said, at the end of 2014, beginning of 2015, there was something that a lot of people looked into, and there was definitely a lack of experience paired with a large spectrum of success. and we've looked at different completion technologies. As far as geomechanics are concerned, that's really something that came out of the data that we collect. We are able to do a stress analysis from the microseismic data, so we've developed a workflow on that end, and that was really necessary to integrate our microseismic data into frac models, which is kind of the standard workflow in a lot of our client organizations. So we had to provide something as input data for those models. So starting with stress analysis, this is just a quick overview of the analysis that we do based on the microseismic data. Because we're able to get a focal mechanism for every event, we can derive the orientation of maximum horizontal stress from the total population of microseismic events. So we integrate other data such as a density log, some DFIT data that we analyze. If we don't have a DFIT, we can take ISIP data from the actual pump curves, and together with that and our stress inversion, we can determine the orientation and magnitude of all three principal stresses. And obviously that's important input data into your frac models, into your geomechanical models, earth models. So that's an overview of what we've done on the geomechanics side. As far as the reservoir engineering side is concerned, this here gives you an overview of the production forecasting that we're able to do because we have our discrete factor network that we built on the microseismic events, and we understand the distribution of that permeability enhancement in your stimulated reservoir volume because of that fracture network, and the differentiation between propped and unpropped fractures allows us to model depletion in the long term. So we can compare production one well relative to another and actually quantify production for individual wells and forecast production and EUR with data that we get from microseismic events. As far as completions engineering is concerned, we've evaluated a number of completion technologies recently. There's been a lot of improvement on the completion technology side and treatment design, different proppant types, different fluid types, and compositions, and we use microseismic as the response of the reservoir to the treatment to a particular combination of completion and treatment design parameters to understand how the reservoir responds to that treatment, and compare different completion and treatment designs to each other, compare the amount of permeability enhancement. So on the left-hand side here at the bottom, you can see different permeability enhancements along the lateral compared to each other for one completion technique compared to another. We have two different designs here. We can not only compare that visually, but actually quantify it and relate that back to production and EUR for these wells. As far as refracs are concerned, something that we've noticed when we first started monitoring refracs was that we get a lot of events in the heel or close to the heel of the wellbore, and not a whole lot of events, if any, along a large portion of the lateral. So we built a geomechanical model and tried to understand the distribution of pressure inside the wellbore, and at what point we're generating new fractures, at what point we're just opening existing fractures. And we found, based on a modeled pressure profile in the wellbore, that before going in with your re-stimulation treatment, you really need to elevate the pressure in the wellbore to allow for the initiation of new fractures. So we've monitored that in real time a few times where the well was, if you will, prepared for the refrac. The pressure was elevated to where we then see microseismic events along the entire lateral, and sometimes even in areas that you haven't accessed with your initial treatment. So in summary, to start at the beginning, we looked at break-even prices. Those break-even prices are at a historic low right now. They're expected to increase mostly due to the reinflation of service costs. As far as capital budgets are concerned, the increase in capital expenditures for 2017 will allow our clients to focus on production growth, accelerate their development plans, and obviously also invest in technology to facilitate that production growth. As far as international shale development outside of North America is concerned, that's largely restricted to Argentina, and that's certainly where we see the most activity and the most interest for this year. In terms of long-term energy consumption in the U.S., it's actually going to remain relatively flat, rising at only about 5% by 2040, as compared to a 20% increase in total energy production. Something that we're going to see for those shale plays is a continuation of technology improvements. We're going to be able to drill faster, complete better, and increase EORs per wells, and in these shale plays that have a substantial aerial extent, that's going to have a significant cumulative effect. So we're going to continue to see technology improvement. Certainly on our side, as far as we can control it, we have heavily invested in technology development. We'll continue to do so to not just lower product costs for our clients, but provide additional value and really have an impact on their bottom line and provide return on that investment in microseismic monitoring. And that's also why we're really focusing on actionable results and, like I said, the impact on our clients' bottom line. Thanks for tuning into this one's webcast. I hope you sign up for the next one. If you have any questions, you can email me at the address on the screen. Thank you.